The markets may look calm on the surface today, but underneath some big shifts are happening. From tightening farm credit to acreage uncertainty to quiet moves in global grain flows that could matter more than today's price action. Good morning and welcome to Boots and Bushels, your daily look at the markets that feed America. Whether you're headed to the barn, the shop, or the cab, thank you for spending your morning with me. Let's start with where the markets settled today, then we'll talk weather and dig deeper into the ag news that's shaping decisions well beyond this week. Corn finished slightly lower. March corn settled at 420 and a quarter per bushel, continuing to chop sideways as the market waits for a clearer demand story. End users are covered for now, and until exports or ethanol demand accelerate, rallies are struggling to stick. Soybeans led to grain complex higher. March beans settled at 1053 per bushel, posting a solid bounce after recent pressure. This wasn't panic buying, it was value buying. A reminder that sub 1050 beans still attract interest. Wheat closed modestly lower. March Chicago wheat settled at 510 and a half per bushel. Global supplies remain ample, and U.S. wheat continues to face stiff competition from the Black Sea region. Rice quietly edged higher. March rough rice settled at 1060 per hundredweight, continuing to grind higher within a narrow range. Cotton finished lower again. March cotton settled at 64.71 per pound, weighed down by sluggish global textile demand and uncertainty around consumer spending. Overall, the grain markets aren't breaking, but they're not inspiring confidence either. Live cattle futures closed mixed but remain near historically strong levels. Tight supplies continue to support the market, even as packers push back where they can. Feeder cattle finished steady to higher, helped by firm cash cattle and continued optimism around calf availability. In dairy, Class 3 milk futures were mixed. Demand remains uneven and producers are still navigating high operating costs, despite some recent relief on the feed side. Livestock markets remain supported, but everyone is watching demand closely. Weather across much of the Midwest and Plains remains seasonable, with no major widespread threats in the near term. Dry pockets persist in southern plains, while parts of the Delta continue to see periodic moisture. Nothing alarming yet, but weather volatility later this winter could still influence spring planting decisions. The USDA raised its estimate for U.S. corn production again, pushing total output north of 17 billion bushels. That's a big crop by any historical standard, and it immediately reinforces one thing: supply is not the problem in this market. Ending stocks were also increased, which tells us demand hasn't kept pace with production. Ethanol demand is steady, feed use is solid, but exports remain the missing piece. When USDA raises stocks, it's essentially saying the market still needs to work harder to move grain. For corn producers, the message isn't that prices are broken. It's that rallies will likely be work rallies, not runaway moves. Any strength we see will probably be tied to demand surprises, weather scares later in the year, or logistical issues, not supply shortages. On soybeans, USDA left production mostly steady, but still pegged ending stocks higher than many in the trade would like to see. That tells us the soybean market is balanced but fragile. It doesn't take much buying to lift beans, but it doesn't take much selling to knock them back down. This is why sub 1050 beans will continue to attract interest. Buyers see value, but they're not chasing higher prices yet. Until exports accelerate or South American production stumbles, beans remain range-bound. Wheat was the quietest part of the report, but maybe the most telling. USDA kept global wheat supplies comfortable, which continues to limit U.S. competitiveness, even with weather concerns popping up overseas. Wheat remains a market where rallies are quickly sold unless something truly disruptive occurs. Now zooming out, the bigger takeaway from the WASDE isn't big crops, it's margin pressure. High production doesn't automatically mean prosperity. When supplies are ample and demand grows slowly, the burden shifts back onto producers to manage risk more actively. That's why marketing discipline matters more in this environment than in shortage years. Another key point is how this report feeds into acreage psychology. When USDA confirms big supplies and heavy stocks, it makes spring planting decisions harder. There's no obvious best crop right now. Corn, beans, wheat are all offering thin margins at current prices. which means rotations, cost control, and risk management will likely drive decisions more than outright price optimism. And finally, remember this, the WASDE is a snapshot, not a prophecy. It reflects what USDA sees today based on current data. Markets don't trade today's facts forever, they trade tomorrow's uncertainty. That's why even in a bearish report environment, volatility never truly disappears. Another important story right now is tightening farm credit conditions. Rural lenders are becoming more cautious, not because farms are failing, but because margins are thin and volatility remains high. Loan renewals are seeing more scrutiny and cash flow projections matter more than they have in years. This doesn't mean credit is disappearing, it means discipline is back. Another growing concern of 2026, acreage uncertainty. With corn and soybean margins both tight at current price levels, producers are weighing rotations carefully. There's no obvious winner crop right now, and that indecision is already showing up in early conversations between growers and lenders and input suppliers. We're also seeing global grain competition intensify. South American production remains a key wild card, especially for soybeans and corn. Even without record crops, steady export flow from Brazil continues to cap upside rallies for U.S. grain, forcing domestic markets to compete on price rather than scarcity. In cotton, the story is demand, not supply. Apparel sales remain sluggish globally, and that weakness continues to ripple back through the fiber market. Until consumer demand improves, cotton may struggle to find sustained support. On the policy side, there's growing frustration around the lack of progress on longer-term farm safety net updates. Producers are heading into another season with outdated reference prices and risk tools that don't fully reflect modern cost structures, a concern that keeps surfacing in farm meetings across the country. Finally, there's a noticeable shift in producer mindset. After several years of volatility, many are prioritizing risk management and cash preservation over aggressive expansion. It's not fear, it's realism, and it's shaping market decisions, equipment purchases, and acreage plans. Today's markets weren't dramatic, but the underlying story is important. Soybeans found support, cotton remains under pressure, rice continues its quiet climb, and livestock stays fundamentally strong. The bigger picture is this: margins are tight, decisions matter, and patience is becoming just as valuable as timing. Thanks for starting your day with boots and bushels. If this update helps you stay grounded in what really matters, make sure to like, subscribe, and share the show. It helps more producers find us. Keep your boots muddy and your bins full. I'll be back here Monday with a new episode.